Continuing with topic 5 of paper 9, we'll now look at commodity options. That's section 524 on page 5.12. Now, these options are traded on a variety of underlying instruments, both exchange traded and over the counter, and include those based on precious metals, agricultural grains and meat products, and options on energy products. Now, they can be further broken down into options on the physical commodity or option on the commodity future. So you're buying an option to buy or sell the underlying future. And in doing so, you're avoiding the cost of the initial and variation margins. So that's one of the benefits of commodity options. Okay, we come to section 5.3, exchange traded commodity derivative products in Hong Kong. And here we have products that are traded on London metal mini futures, gold futures, silver futures, and iron ore futures. Now we've got details on the London metal mini futures in section 531 and have a read through them. It's unusual for that level of detail to be examined. 532, the gold futures, launched in renminbi and US dollar gold futures July 27. We're told the underlying asset, 1 kilogram of gold and contracts can be physically settled. You actually deliver or take delivery of gold. 533 looks at silver futures. Futures exchange in Hong Kong launched renminbi and US dollar silver future contracts in 2020. Underlying asset, 30 kilograms of silver. Contracts again can be physically settled. And it's common for producers and purchasers of gold to enter into forward agreements. Interesting that we've got the purchase of gold under silver futures. Nevertheless, that is a commonality, and we're going to address that in a moment. 534 looks at iron ore futures, introduced into Hong Kong November 2017, and we're told provides a transparent, efficient risk management tool for physical and financial users, offering investors a highly China-relevant underlying for investment, and that's based on China's demand for iron ore. Now we'll look at pricing of commodity derivatives. We don't have to look very long. There's not much to it. We're told that the pricing fundamentals are based obviously on supply and demand, but the fair value of a commodity derivative is the cash price in the market currently plus cost of carry. So if you're looking at a future that is for settlement in 3 months' time, you'll base it on the current cash price and the cost of carrying the commodity, let's say orange juice, the actual storage of orange juice for 3 months, and you will add that to the cash price to get the fair value of the future. And cost of carry naturally reduces the closer you get to contract expiry, and at expiry the cost of carry would become zero, and that point can be an easy question gain if they were to examine it. Okay, let's look at hedging using commodity derivatives. And to start off with, we're going to consider using a gold swap. Now, this often is examined, the material in this section. So I'll go through it and then I'll highlight how it's examined. So a miner and producer of gold who is concerned about the fall in the price of gold, because the producer is digging up the gold and hopefully selling it at a good price, could hedge price risk in any one of the following ways. 4 ways. Enter into gold forward contract for the sale of its production. So you enter into a contract where you get a price now that you're going to settle in the future. Sell gold futures, and you'll be selling the future on a futures exchange. Enter into a gold swap, and we're going to look at that in a moment, or purchase gold put options. Now, we're told in reality, the miner producer would probably enter into a swap for the following reasons. Now, the question often is, which of the 4 choices would a gold miner or gold producer choose? What is the best choice, the most profitable, or however they word it? And the reasons that it's not forwards, futures, and options are as follows. A swap agreement is longer term than the other instruments. A swap agreement requires less ongoing management than options and shorter dated forwards. So with a swap, you enter into it and off it goes. And we're told there's no ongoing management, whereas there is with options and short dated forwards. Obviously, with the options, you've got the premium. And compared to futures, a swap agreement does not involve the tying up of capital in initial and variation margin. So all four can be used to hedge the price of gold. But this section is telling us that a swap is often the preferred choice. Be aware of that for the exam, because that often you get a question with those four alternatives and you've got to choose the best alternative, and it's the swap. So the actual workings of the gold swap: gold producer digging out the gold and selling on the spot market. The exposure is the price coming down. So you find a counterparty, you agree, the counterparty will pay you a fixed rate, and in turn, the gold producer will pay the counterparty the spot price for gold. So what we've got is the gold producer selling the gold on the spot market, receiving the price, and whatever price is achieved, those monies are then paid on to the counterparty. Meanwhile, the counterparty is paying a fixed rate to the gold producer. So the gold producer is reducing the uncertainty of cash flow. Let's look at another situation of hedging, this time using crude oil futures. The example: DD Airways wants to hedge against the rising oil prices. Jet fuel monthly expense estimated to be $100 million US. Two actively traded crude oil futures, that's WTI and Brent. Both contracts involve 1,000 barrels. DD Airways decides to use WTI, the December contract, for which is trading at 135.9 per barrel, decides to hedge for half of the jet fuel. So we're not hedging 100%, just one half. The question is, what are the cost savings and increases in expense if WTI crude oil settles at $70 US, settles at $120 US, and settles at $170 US? Well, there are three outcomes. Let's look at the how many contracts to start with. Contract size of all futures, we take the 135.9, that is the strike price, multiplied by 1,000. That is the standard contract size, and that gives us a price of 135,900. So how many contracts to hedge the exposure of $1 million US? We take the 1 million, we divide by 135,900. We see there's 736 contracts required. However, we don't want to hedge the full exposure. We want to hedge half of the exposure. So we take half the contract size, 368 contracts. So DD Airways buys 368 contracts, 135.9 strike price, to hedge half the exposure to a rise in fuel costs. First outcome is that oil futures settle at $70. The price falls. So there is a benefit, there's a fuel cost saving, but we will make a loss in the futures market, and the overall cost saving there, 24,251,200. Outcome two is that the oil futures settle at 120. Well, when we're saying they settle at 120, that's also the market price. Well, we've got a small saving because the price was 135.9. It's gone down to 120. So we do make a fuel cost saving, and we make an oil futures loss. So the overall cost saving is reduced to a net of 585,200. And then outcome three, the crude oil price goes up to 170. That's what you're hedging against. Your fuel expense increases 25,097,600, but you have an all futures gain. You gain in the futures market. That's the reason you did it. Fuel cost has increased, but your overall cost increase is reduced by your profit in the futures market. So our overall cost increase is 12,548,800. Now the table is probably the most informative aspect of this example. It shows you the savings and the costs of the three future prices when you're unhedged and when you're half hedged. And you can see that the volatility of corporate earnings is reduced if you're half hedged as opposed to unhedged. And finally, Section 8, trading strategies for commodity derivatives. This is just out and out trying to make money. Speculator believes price of silver will soon increase sharply. Rather than risk capital being tied up in a futures trade, that's one of the downsides of futures, because you've got the initial and variation margins that you may have to put forward. She decides to purchase options on silver futures, but you've got the premium. Current futures price, 25.25. So what we're doing is we're buying an option on a future. She buys a call option at 25.25. So that means that the speculator has the right to buy a derivative, a silver future. She has the right to buy a silver future at a price of 25.25. And the strike price is 285. I beg your pardon. The option price is 285. The strike price is 25.25. So what's the payoff diagram? Well, as ever, it's a long call. We're investing money, the 285. And if the futures price does not increase, then we just we give up the premium. But if the futures price does increase, then we'll exercise at 25.25 and we'll sell at the higher price, thereby making a profit. And the break even is 28.10 for this strategy. The downside of options is the premium you have to pay, but the upside, the positive, is that unlike futures, you do benefit from price upside, the price going up. Okay, that brings us to the end of topic 5. A lot of fairly complex material in there with regard to hedging strategies, trading strategies. That you're not going to have an enormous number of questions from topic 5, but they can be quite tricky. Be prepared for the currency forward price calculation, and also be prepared for putting forward a commodity swap as the favored alternative over options, forwards, and futures. Best way to study for topic 5 as ever is to do practice questions, and we recommend that you go to Examinator.online, where there are many paper 9 questions waiting for you.